This is Avijit Chatterjee and Rohan Singh recording our weekly market commentary about what happened in the markets this week. This is for the week of May 6th. I'm recording this on Saturday morning, May 11th. The agenda today would be talking about the markets, the direction of where we think things might be headed. And then after that, talk on some key stocks that I have discussed in the recent past, such as last Friday, we talked about Berkshire Hathaway. So I'm going to talk a little bit about that. Some earnings this week, Disney in particular, had a breakdown after earnings. So I'll talk about Disney. Utilities have been on a tear, climbing the last several weeks, the last 3 or 4 weeks. XLU, the spider utility, has been outperforming the S&P and yet again closed as the best performing sector for this week. And also talk about the Indian stock market, the Nifty index in particular. This is the 50 blue chip stocks of the Indian stock market. Talk about that. So before we do that, I do want to point all of you to our website on, in particular, our YouTube channel, youtube.com/Chartsarefun. We request you to subscribe to this channel, and also if you like the videos, please hit the like button so we can share it with a broader audience. Also, our blog site, chartsarefun.substack.com, we request and encourage you to sign up for that as well. It's free. You just put your email and you subscribe to it by just getting regular notification. We publish blogs daily, Monday to Friday. And this week in particular, we published a blog about Disney's earnings, which I'm going to talk a little more in from a technical analysis. Talked about TLT, the Treasury ETF, opportunity to invest in the Indian stock market, what kind of pullback could shape up there would be a good time to then get in. And then utilities was a blog I published yesterday. I'm going to talk about XLU. So the macro trend in general is we had the US job market data that came out last Friday. And from that point onwards, market actually has been reacting positively to weak data. So the job market cooled down to some extent. 175,000 jobs was reported in April, when the market was expecting over 240,000 jobs to be added in April. So that was a bit of a slowdown. Unemployment rate also rose from 3.8 to 3.9. So the trend of the employment weakening, market likes it. Market likes weak data now because the key thing that has happened is interest rate expectations, which were up to 6 cuts for this year, has now come down to 1 or 2. And the primary reason has been consecutive months of strong inflation. So that's market liked it. And then to add to that, the weekly jobless claims came out this Thursday, and that also showed a trend with over the highest in the 8 months as labor market eases. And this in particular was, as we can see, the jobless claims increased 22,000 for this week, adding up to 231,000. Market has been keeping for this year mostly within 225,000 and less, but adding up to 231,000 weekly jobless claims was a concern, so which actually means the economy weakening and market likes it. So that was actually positive for the stocks. Also, the Michigan consumer sentiment came out, and finally the consumer is getting a dent of inflation, and so there is concerns from consumer, with 1-year inflation expectations now rising to 3.5 from 3.2, and the index itself, the consumer sentiment index, fell to 67.4 in the May data that just came out. So that's a concern. That's something that market again thinks that the economy is weakening, and hence market likes it because market thinks the Fed will be less hawkish, or rather be dovish, and perhaps the interest rate, the cutting of interest rates is back in the picture, and perhaps instead of not expecting any cuts, maybe 1 or 2 cuts. This is very likely this year. So that's kind of positive what the market expects. The key barometer of the stock market's immediate direction and also interest rates is this 10-year yield chart. We've shared this before. A key pattern here is called an ascending triangle pattern. You can see that the line joining the resistance levels at 4.35 is at the top, and then the rising bottoms from 38.17, 40.38, 41.83. So that is an ascending triangle pattern where the lows are ascending and the tops in this case is a horizontal line. A measure target on that is from 37.85 to 43.54. Subtract the difference, add it to 43.54, it comes to 49.23. So that's the target where we think 10-year yield might be headed, which is near 4.92%. We didn't go as far. We went up to 4.73, 47.37, and since then have pulled back. We do see a bullish cross of the 50 above the 200 moving average, the 50 in blue and the 200 in red. Both of the moving averages are climbing. So that is something to look into to see if this yield now has a rising trend, and that would not be good for the market. So that's something we're watching. We also notice this island cluster with a gap up and a gap down in the October timeframe. And by the way, a similar thing happened in the last year's summer to fall. So from September to October to November, we noticed that the 10-year yield had gone up to 4.7, pulled back to 4.5, and then back it touched to close to 5%. And at the point when it then broke down in early November, that's when the market took off from late October to early. As long as the 10-year yield broke down from that 5%, 4.9 to 5% range and started trending lower, market took off from there. So we can expect a similar thing if we do have a reaction to the CPI data. Market is patiently waiting for the CPI data. The April CPI data will print next Wednesday, and that's May 15th. And if the market likes that data, as in the CPI data is tame, which is the consumer price inflation data, then you can expect the 10-year yield perhaps not to go to the 5% level. It could actually be positive for the market, and we could perhaps break below this key 4.35. What would that mean? That would mean that the ascending triangle pattern was invalidated. So there's a possibility. So for the bulls, they're hoping that the 10-year yield does break below key support at 4.35. So it was previously resistance is now support. And right now the market tested 4.42, rebounded slightly at 4.5. But if the inflation data is tame next on the 15th, it's a possibility we break below 4.35. And that means we could get a similar kind of a declining 10-year yield, which could mean that we could have the market take off and rise to higher highs or new highs, all-time highs. So that's something that is the barometer that we are all watching for the next week. Now, last Friday, when we recorded our weekly session, we talked about the doji reversal candle in the silver and GLD, SLV and GLD charts. So this is where we're going to walk through the, call it the candlestick glance across the core ETFs. These are the core index ETFs, SLV for silver, GLD for gold, diamond, DIA, SPY for S&P 500, QQQ for Nasdaq 100, IWM for Russell 2000, so on. So key is when we talked about this doji reversal pattern that you noticed, this was the, last Friday, that was a bullish reversal. It silver had pulled back to test its rising 50-day moving average, and from there it basically took off. It gapped higher on Monday, and all 5 days of this week it had trended higher. So it closes the strongest. So if you see the rate of change of the 5 days, that's at 6.4%. That means silver rose 6.4% this week, the highest in the ETFs that we're watching here. Gold was next at 2.7. That's the 5-day rate of change. Similar thing, there was a doji reversal last Friday, and after that, it climbed this week. Diamond, which is the Dow Jones, actually outperformed the other key indexes. DIA, as you can see, next performed at 2.17% this week. And you can see that all 5 days of this week, each candle here is a day, have been climbing. So it gapped higher after the weak jobs data on last Friday, and so that's a Friday's gap higher, and from there it just kept climbing. So a solid week for Dow Jones. In a similar way, a solid week for the S&P 500. It gapped higher after the jobs data last Friday, and for the last 6 consecutive days, it has been climbing. If any, if you look at the number of positive days in the Dow Jones, it's actually 1, 2, 3, and then 5, 8 consecutive days it has climbed, the Dow Jones Industrial. This the S&P 500 is a similar 8-day climb. As you can see, 1, 2, 3, 4, 5, 6, actually 7 days of climb. QQQ did take a little bit of a pullback on Wednesday this week, but then closed at the highs recovered from the initial drop and closed towards the highs of the day, and then climbed the last couple of days. So QQQ performed at 1.51%. Small cap was the weaker among the core indexes, and in fact, yesterday you can see a red candle almost covering over the it's almost like you'd call it an outside day candle coming up from outside the candle, but then closing towards the low of the day and towards the low of the previous candle. So that is a bit of a bearish looking candle for the small cap. So I'm going to talk a little more about that as we look deeper into IWM. The dollar had 0.31% gain for the week. It has been mostly trending lower since that weak job data, because market thinks that interest rates are going to be trending lower, and interest rates trending lower is dollar bearish. TLT is the ETF for 20-year Treasury. So if the Treasury yields come down, TLT goes higher, because that means that the market expects weakening yields, and that means bonds are rallying, and when bonds rally, TLT rallies as well. So TLT has been upward trending as it goes inverse to the dollar or the yield itself. So as the yield came down, TLT rallied. So that's something, but the key level is for TLT is the 91 level as the support, and it also was tested its declining, in this particular case, 50-day moving average in red, failed right there. So it's something we have to watch to see if TLT can take that out and zoom higher, or would it fail and resume its decline. Our target previously shared on TLT is closer to 84.5 after the breakdown of a descending triangle pattern from 99 to 91. But we need to watch and see what it does after the inflation data this Wednesday, the 15th. Emerging markets likes a weaker dollar. So while the dollar weakened, emerging markets took off and actually broke above a key resistance as 42 and closed at 42.5. So it was up not as much from the week at 0.27, but relative to where it was from late April, mid to late April, it has had a steady and a strong climb. You can notice from the lows below 40, 39.5 to 42.5. Bitcoin, interesting enough, is struggling a bit. We can see that there is a bearish cross of the 20-day below the 50. The 20-day is declining, the one in blue. The 50 is kind of plateauing out, and potentially, if that starts declining as well, we could be setting up for a bearish trend in crypto Bitcoin for the next couple of months. But right now, it failed. It did recover early May, GBTC, which is the core grayscale Bitcoin ETF for Bitcoin. It came up to test its declining 20-day moving average, failed there, and then yesterday had a bearish looking candle, red filled candle, kind of opening at the highs of the day and closing at the lows of the day. And so that's something to watch, is looking at this currently, there's a possibility that we could be still on a little bit of a declining trend in crypto. Volatility is inverse to the markets. The fact that the market has been rallying quite a bit on weak employment or weak, Michigan sentiment data and overall weak economy data, VIX took a pullback. VIX actually had peaked over 21, and from there has pulled back and closed out this gap. There was a gap in the VIX just below 13 that it had left in early April. It filled that, it completed that. So that's something to be watched next week. Are we going to kind of take off as the market breaks out on tame inflation data, CPI? And in that case, you could expect VIX to continue its decline as the market takes off and breaks to new highs. If it doesn't, then VIX could have a snapback higher, and that could mean the market could then pull back. So that's something to look at. Now, what happened in the ETF, the core SPDR ETFs, or the SPDR sector ETFs? So there are 11 of those, and this week turned out all 11 were positive, all 11 closed positive. So you can see that the best performing was utilities, up 4% for the week. Then was financials, up 3.16. The basic materials, 2.58. Whenever we know that silver, gold had a solid week this week, whenever silver, gold, precious metals are a part of basic material, though we do have steel, we do have copper, we have aluminum, other materials as well, but overall basic materials did well this week, and so it was up 2.58. Industrials had a decent week as well, 2.37. Notice the top like 6 or top 8, technology is not there. So technology has been underperforming a bit, but leadership has transferred from technology recently to other sectors. So right here on the top is utilities, financial, basic materials, industrials, staples. That also had 2.29% for the week. Real estate 2.13. When interest rates come down, we showed you the 10-year yield chart, pulling back from a 4.7 to 4.73% down to closer to 4.42%. That's good for real estate. So real estate, as a result, had a decent week. Communication services is where the internet stocks are. This is where Google, this is where Facebook, Meta, and Netflix and others are. That had a decent week, just a little below 2%, 1.97, 1.96, neck to neck with the communications with the healthcare. Technology, you can see, did underperform among the bottom 3 sectors at 1.48, and the bottom two were energy. Energy continues to lag, not as much from technology, 1.48 versus 1.36, but the weakest was discretionary, and discretionary came down, and well, not so much came down, it came down earlier, late last week, but then this week kind of, after initial climb after that job data on Friday, kind of stayed flat. It was only up 0.11%. And discretionary is where the retail stocks are. Next week is key retail stocks earnings is going to come out. We have Target, we have Walmart, we have Home Depot. Some of those key retail stocks as a barometer of the consumer weakening is what the market will be watching. So market is expecting a little bit of weakness in the retail economy, and that's where discretionary didn't do so well this week. So that's something to watch. So with that, let's just look at the bigger trend of QQQ and where QQQ is headed. We had previously talked about a cup and handle from the 401 pulling down to 251. Bottom, that's the bottom of the cup that it formed in October 2022, moving back to 385, the right brim of the cup. So 251 to 385, that's 134 points. Add 134 to 385, that takes you to 520. So that's where so this is a cup and a handle, and then the breakout where the QQQ is headed. However, notice what happened summer of last year. 385 to 352, went up to a lower high at 378, pulled back to 350, another lower high at 372, pulled back near 346, and then from there it started the next climb. So this is the first wave of the climb from 251 to 385, then a little bit of a handle forming pullback. So that's wave 1, wave 2, then we had wave 3 climb. And now the question is, has the wave 4 climb already finished with the pullback to 413, or can we expect in a similar way, like you saw, a lower high, pull back to a lower low from 413, and maybe come down to test this rising 50-week moving average in blue near 394. So that's something we need to watch. But key is the negative divergence in RSI as QQQ was climbing. Notice that higher, the lower highs in RSI. So you notice this, that's a negative divergence, and that's what caused this big pullback. However, we have tested the midpoint around the 50 level of the RSI, and as you see in the past, it never dipped too far below 50, maybe a little around 45, and then from there started, because once you're in a bull run, the RSI doesn't weaken. This part that you see where RSI was trading between 30 to 50 is during the bear run in 2022. When a bear run, RSI tends to be range bound between 30 to just below 30 to 50 and keeps failing at 50 and pulling back. However, during the bull phase, once the market is recovered and now on a bull run, it stays range bound between 40 to 70 to 80. And that's what we are seeing. So right now it looks positive. It looks, the benefit is in the favor of the bulls. But the key is, let's quickly look at the daily chart of QQQ and understand what happened in the October timeframe when market did try to recover back in the early October till the point where it then crossed above the, in this case, the 50-day moving average, and then it failed. And from there, it pulled back to a lower low. From 350, it came to a lower low in 341. Could we be setting up for that is the key thing. So yes, the market has kind of rallied back, but would we be actually doing a cup and handle here from 413 to 433? That's 20 points. with a little bit of a handle pullback from 433 to 420, and then broke higher with this gap up. Are we then looking at the cup measure between 413 to 433 is 20 points at 20 to 433? That's 453. So are we looking for market to climb to 453 next week on a weak inflation data, weak CPI data, or would we fail here like we failed here at lower high and then pull back to a lower low? In that case, that could mean that as the moving averages, in this case the 20 and the 50, the 50 is in blue, the 20 is in red, the 20 did try to come and take over, the 50 failed and then pull back again. In a similar way, the 20 is curving higher back towards the 50, the red line is curving back towards the blue, but could it fail and decline? Now, part of what could be interesting to look at is the 50-day moving average had been climbing steadily till it plateaued out in that 435 region. You can see that it's that 434, 436.63 is where the 50-day moving average is. So 435, 436 is where for the last several weeks it has just plateaued. And what it could mean that, like we noticed here, it could be a slight decline in the 50-day for the next couple of more weeks, 3-4 more weeks, while we get another lower low in the QQQ and then perhaps the climb. So it's possible that we could see some form of pullback in May. However, if this turns out to be a bullish cross, the 20 goes above the 50 and the market breaks higher above 449, that would mean that the market is off to the races and the target for QQQ is 520 and we could have a bullish outcome. Something we am also looking at is a potential head and shoulder. I call it potential because it is nowhere close to confirming of a breakdown. The neckline is in the 188 to 190 level of the IWM, which is the ETF for small cap, the Russell 2000. That's the left shoulder around 205, pulling back to 187, forming a head in this case, making two attempts around 210, 211 to break higher, fail both times. So it's kind of a little bit of a double head, double top kind of head. Broke back to 191, forming a right shoulder potentially in the 205, 206 level. That then breaks down. We are measuring a target closer to 170, and that's where the gap that it left in November when it took off and started doing very well. So that gap right below 170, could that be filled? Bears would ideally hope for that. But bulls may look forward to not happening. And that's a key barometer again. It's directly connected to the 10-year yield. If the 10-year yield breaks below 4.35, you can expect the small caps to take off. It'll cross 212 and this time make a run towards 220. However, if the 10-year yield spikes back higher, and the only reason the 10-year yield could spike back higher is market's interest rate expectations come off again. And why would that come off? If we have heated inflation data yet again. We've had 3 consecutive months of January, February, and March. We're going to get the April inflation data this Wednesday. If that's strong again, as in the inflation continues to be hot, expect interest rate expectations to come down. No more interest rate cuts this year, perhaps. And that would mean a 10-year yield spiking higher, causing small caps. They're so sensitive to interest rates to break down. So that's something we need to watch. Is this going to be head and shoulder, left shoulder, head, and right shoulder breakdown? Or are we going to violate this and actually take off to new highs, in which case the head and shoulder is invalid? I now talked about the market. I'm going to quickly touch about some core stocks. I had talked about Berkshire Hathaway. Warren Buffett had his investor meeting, where he spoke over 5 hours and took questions from his investors, the analysts, and so on. And at that point, I had published a blog last Friday saying that is this a potential double top in BRKB, which is the B shares of Berkshire Hathaway around the 425 level, double top with weak RSI. That's a negative divergence, a lower high of the RSI as it tested 425 twice. Then it came down and it did a double bottom. 396 it tested twice, but as it tested 396 twice, it showed a positive divergence. So at that point, I had in the blog talked about a W-shaped double bottom. A W-shaped double bottom is 424 to 396, 411 testing 396 with a higher low in the RSI. And now if it can break above 411, we could be making another attempt back towards 427. And this is what I published in the blog. So far, it turned out to be a good week for Berkshire Hathaway. It has been climbing, in fact, for the last 8 consecutive days, similar to the Dow Jones Industrial Index or S&P 500. So it's been a very bullish 2 weeks for the Berkshire Hathaway. and it has broken above the bottom on the tip of the W here, 411. It closed at 412. So that from a Berkshire Hathaway, which is like over 40 different companies that Warren Buffett and his um, executives have invested on, or his money managers have invested on. The key is so far that's looking bullish. It's looking like a W shape, which means it's possible that if there's inflation data is not as strong as people are fearing, it's possible that we could continue the climb, and that would mean the market is going to continue its climb. So that's something to look at. Disney was actually an interesting company. It did meet its guidance for our expectations of the earnings. However, there was concerns with a big write-off that it had to take for its investments in Star India, a big Fox property that it bought. It actually had to write off some of the goodwill in that acquisition. A lot of that were cricket-related um, rights that they had, that Star had, that it lost over time, and as a result lost viewers. Overall, Disney's breakdown was a classic head and shoulder pattern. You can see the neckline is around 110, the left shoulder at 115, went up testing the head at 123.74, back to 110, formed the right shoulder at 116, and then broke down. That measures to 96.68. It also kind of, if that happens, will fill the gap that it left from middle of April, around that below 100, around that 98 level. And the way you measure that is 110.21, 123.74, subtract the two. That's roughly 13.53. So subtract 13.53 from 110.21, you get 96.68. So that's potentially a possibility of where Disney could be headed. But right now, it did have a little bit of recovery from the 104 level to a 105.79. Went as high as 107 yesterday. And we need to see, is Disney going to continue its decline? In that case, what would be a great entry for Disney would be that completion of the head and shoulder just below 97 at 96.68. Now I'm going to talk about utilities. First, the bigger picture. This is a utility spider. It's often the most boring sector because what is utilities? It's a safe dividend paying companies, the various electric companies, natural gas, the people that power our houses, right? Power our uh, the electricity and the utilities that we consume. Well, it turns out that it has an ascending triangle pattern. You can see that there is a 65 to 66 is where the horizontal line on the resistance level is, and the lows have been ascending, as in higher lows, 53.81, 58.66, 62.55. A measured target on that is 77.27. The key thing on why it's bullish is the RSI now is above 70. That took almost 2 years. 2022 early it had crossed 70 to show momentum, and it is showing similar momentum. 2022 it showed momentum because that's when we were getting ready for a bear market. In bear markets, and by the way, if you notice that what had happened then was the Ukraine attack had also happened around late 2021 into early 2022. I think it was February 2022 when the Ukraine attack really happened. So at that time, whenever you have uncertainty in the world, geopolitical risk, safe haven, becomes a key thing. So here, that's a safe haven kind of value investor kind of move. In a similar way, we are getting a move this time, but this time turns out that the utilities getting a lot of talk of powering the AI growth. All the data centers, the utility companies had earnings. Dominion Energy, for example, had earnings this week. Talked about its focuses on Northern Virginia as a key region that the Dominion provides utility to. They're talking about huge interest, like massive growth of data centers and burgeoning utility demand in Northern Virginia, for example. So here, if that's where the target is, the utility's got an ascending triangle pattern towards 77 and it's currently in 71. There's a potential 10% nice move possible. If we look in the hourly chart of XLU is an overbought RSI from above 80 coming down to 74. If we get this pullback to test its rising, and you notice that from the middle of April, ever since it took off, it's been hugging along the hourly, the 50-hour moving average in blue and not breaking below it. So if we can get an entry in the 69 to 70 level of a pullback, that would be a great place for an entry. And from below 70, climbing to 77.27 target is an easy 10%. And that's a potential investor play for those who are looking for a safe and easy way to play utilities to get a 10% gain. So with that, I want to talk about the Indian exchange, the Nifty 50, the 50 blue chip stocks. And here a double top pattern is forming out, 22.8 being tested twice. But as the 22.8 double top got tested, look at the RSI that lower high. That's called the classic negative divergence. Where does the measured target of this come to? From 22.8 to 21.8, that's 1,000 points. 21.8 as in 21,800. 22,800 was a double top. So 1,000-point move from 21,800 measures to 20,800. So that's potentially a place where this could come down. In fact, this is also negative divergence in the PPO with a lower high, and it has underperformed the S&P as well for the last couple of weeks. Notice it's now down 6% relative to S&P 500. If you then add the 200-day moving average to this, so that we see where that 200-day moving average is on this core index, turns out that the 200-day moving average is right at 20,800 as well. This is the one in green. So if you look at the pullback, this head and shoulder could effectively be a nice 200-day moving average test, which is climbing. When a 200-day, 50, 20 are all climbing, here with a bearish cross of the red, which is the 20-day going below the 50-day in blue. So a bearish cross, a potential double top breakdown measuring to 20,800, which is the rising 200-day moving average. That could be a perfect time to consider entering the Indian stock market. There are many ETFs in the US exchange that trades for the Indian stock market. INDA in particular is linked with the Nifty index. So that's the MSCI India ETF, INDA. There are others like IFN. There is things such as EPI. Wisdom Trees ETF is EPI. There's also Nifty NFTY. That's also a ETF or just directly linked to the Nifty index. So those are various US related ETF tickers that someone could use when the 20,800 target comes through for the Sensex. Sensex is the other index of the exchange, but this one in particular is the Nifty 50, the 50 blue chip. Sensex, the BSE one is 30 stocks, similar to the Dow, 30 stocks composing of the 30 largest companies. In India, that's the Sensex 30 index, but this one for the more broader is the Nifty 50. And so that target at the 200-day test of 20,800 would be a great entry for the Indian market. With that, good luck. Key recap is we're watching the CPI data tomorrow. We'll see how that goes. And based on that, market could have a key reaction, either break out to all-time highs after a tame CPI, or we could get a pullback. And in that case, the pullback would be kind of come back and break below the lows that we saw recently in April, middle of April, is when QQQ bottomed out at 413, and see where we head from there. With that, good luck, everyone. Happy investing next week.